Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks falling here to kick off a busy week with NVIDIA earnings and the September jobs report in focus. Let's welcome in now Jared Blickery, joining us to break down the headlines. Jared, what are you seeing in the markets?
Thank you, Josh. Some pretty heavy selling across the board here. As you know, Dow down almost 700 points now. That's good for about 1.5%. And just take a look at this chart. We were kind of flirting with the unchanged line here around the lunch hour, and then we have just kind of fallen here. I wouldn't call it falling off a cliff because it's been orderly selling here, not panic selling, but nevertheless, it is notable. NASDAQ Composite down a little bit less, so tech stocks taking a deep dive, but then again, a lot of other things are too. S&P 500 down a little bit less than that, 1.33%. And the small caps, they are down the most. Russell 2000 down 1.85%. And another measure of small caps, S&P 600, which includes only profitable companies, that's interesting, that is down even more, 2.3%. Let's take a look at the VIX, because we have seen this kind of inching up and ratcheting up over the last few days. We had a bigger selling day last Thursday, and here you can see we came in and we had a high of about 22, 23 on that day. We are greater than that, or at least that intraday print right now. So we wanted to keep an eye on volatility. Meanwhile, the bond market, bonds are going up and the yields are going down. Let me put this on an intraday where you can see the 10-year T-note yield, that is down 2 basis points to 4.13%. 30-year down to 4.73%. That's only a 1 basis point move, so nothing big happening in bond land. Meanwhile, U.S. dollar index inching up. It's up about 0.25% there. And I just want to show you Bitcoin. Maybe you circle around to that later. That is down to 91,500. So kind of ouch if you're in the crypto space right now. But let's check out the sector action. Only utilities is positive right now. XLU is up 0.5%, and tech, I mentioned tech before, that is the biggest loser, down 2.25%, but financials and energy are close on its heels, each of those down more than 2%. And taking a look at the NASDAQ 100, lots of losses. Yes, Alphabet is a big standout, up 2.7% there, but chip stocks and software stocks, and we'll drill into each of these respectively. Here's the semiconductor space, a lot of red, not too much dark red. Here's the software space, a little bit more dark red. Oracle down 3%, so is SAP and Salesforce. Shopify down nearly 5%. Let me just show you the Dow here real quick, because we don't have a lot of green here. Walmart, a staple, kind of a defensive stock, that's a little bit in the green. J&J up 1.5%. Then you've got some healthcare names. Biotech is actually doing well today. Amgen up 1.5%. So let me just show you a screen with some green. One of the few that you're going to see here, that would be pharmaceuticals. So here's where that J&J trade was. I was just showing you. And Amgen, Regeneron up 1.6%, but we got some losers in this mix as well. So all in all, pretty risk-off day. And I did mention Bitcoin before, so let's circle around to that. Bitcoin down 2.7%, Ethereum down even more, and here we have the chart, and it looks very similar to that which has happened to stocks today, which is started off kind of around the green, and then we've just kind of slid over the last few hours into deeply negative territory.
All right, thank you, Jared. Appreciate it. Well, Bitcoin slide may be telling investors something about the broader market. Recent note from Citi pointing to crypto weakness as a potential warning sign for equities, but saying liquidity could soon turn and revive risk assets into year end. For more, Dirk Willer, head of macro strategy and asset allocation at Citi. Dirk, it is good to see you as always. Let's start with that recent note from you all, Dirk, where you were talking about Bitcoin's recent weakness as sort of this warning sign for stocks. Since you wrote that Bitcoin's even weaker, but start there, Dirk. What is this warning sign you're referring to?
Yeah, thanks for having me on. It's interesting actually that when the equity market was still doing really quite well, we noticed the divergence with Bitcoin, and it's actually somewhat rare. So Nasdaq and Bitcoin both trade with a positive correlation. And you had episodes in the past where Bitcoin diverged to the downside, and that was at times a negative harbinger. So we backtested that, and we found actually it's fairly reliable. So if Bitcoin trades below its 55-day moving average, the information ratio of the Nasdaq is just 0.5. If it's above, it's 1.5. And of course, both are positive numbers because we essentially were in a bull market for a long time. But there's meaningfully better performance for the Nasdaq when Bitcoin is essentially part of the bullish sentiment rather than when it's diverging.
So in your note, Dirk, correct me if I have this wrong, we're trying to find explanations for what's going on with Bitcoin. Were you pinning that on tightening liquidity?
That is one of the explanations. There are a couple of things going on in Bitcoin that are interesting. First, there was a flash crash in early October. And that, for Bitcoin itself, it was a 14% move down over 2 days. Maybe not that drastic, but some of the altcoins really got sold much, much harder. And after this flash crash, we saw that the flows into the Bitcoin ETFs and so forth really changed. So the flows really never recovered, and so retail was apparently somewhat shell-shocked by that day, and we saw outflows. The other thing that happened is that I think a lot of the institutional investors trade Bitcoin with a bit of a trend-following mindset, and so we broke some of the moving averages that they tend to look at, and that is also reducing the source of demand. But the third point is what you were mentioning, and that is that the liquidity which we measure by bank reserves on the Fed balance sheet, dropped by a bit more than 500 billion. And that happened because the Treasury increased the Treasury General account at the Fed by selling a lot of T-bills. And there were two reasons for that. One is why this TGA account was so high. One is that that during the government shutdown, the Treasury didn't spend as much, so that account rose mechanically on the back of that. But secondly, they did sell more T-bills than is typical, and so we are thinking going forward, the liquidity squeeze, so that explanation for the Bitcoin weakness should actually get much better because we expect TGA to at the very least flatten out and probably decline, meaning bank reserves and liquidity should improve between now and the end, partly because of the reopening and partly because the Treasury sold so many T-bills already.
What I thought was interesting too, Dirk, is you were telling clients that stocks were holding up despite that tightening liquidity because of, you were saying, the AI story, the AI narrative. And I was wondering if you think that disconnect you're kind of pointing to there, is that sustainable into year end?
Yeah, I mean, we're obviously hoping that Bitcoin catches up with the equity market rather than the other way around. And, one reason for hope would be this improving liquidity environment. Having said that, there were, of course, two more structural negative stories for the equity market. One was that the December Fed cut was put in doubt. And, of course, a lot of the bullishness was based on the idea that the AI story is very strong, the equity market is very strong, and maybe in a bubble, and the Fed is cutting into that, and that is of course a very bullish development because usually the Fed is leaning against these type of U.S. equity market moves. Now, if the Fed would not cut, that removes part of the bullish story. I don't think that would be the end of the bull market, but it would certainly lead to a pullback, and we're seeing part of that. Now, Citi still expects a cut. Our economists still think December will be a cut, at least if we should get the employment data, because I expect weak employment data for October and November. If that comes out in time for the Fed meeting, we expect the Fed cut. That might be helpful. The other point you question is AI narrative. That has also weakened, admittedly, and there were many questions asked about OpenAI in particular and so forth, and that has led to a pullback too. But we don't forget we get NVIDIA earnings this week, so that could reset the AI narrative.
Well, on the AI, what's interesting, Dirk, is you have these questions. I'm curious to get your take on it, on this sort of AI-driven debt financing, big tech issuing billions in bonds. I mean, do you look at that, Dirk, and say, okay, that's healthy, or no, that's bubble behavior?
I mean, it's a normal part of what happens. In 2000, you had a lot of debt issuance, of course, for the internet build-out, and that was not the sign that the bubble was over at the time. And of course, the hyperscalers in particular have very strong balance sheet, negative net debt, and could issue a lot. I think it's more the neo clouds and so forth where people get more concerned. We saw some of the CDS markets starting to move. for some of the sort of smaller companies outside of the hyperscalers, and that is never a great sign. But I would say just because the balance sheet is so solid of the hyperscalers, there is a fair amount of debt capacity left, and it's just a matter of which companies will have to finance it.
So bottom line, Dirk, listen, we're talking liquidity trends and AI debt, but bottom line, you're telling clients, they ask you where are the smart opportunities, Dirk, as we head into year end here and out to 2026. Where do you see them?
Yeah, I think it's too early to give up on equities, but we also advise hedges because we do believe we are essentially in an AI bubble. At least in the macro strategy team here, we believe that. And I would say that is not necessarily a reason to sell because often the last parts of these bubbles can be explosive. So we want to remain involved. But whenever you are in the bubble, you have to put more hedges on. I think that is quite clear. And we do think that credit is actually a better hedge for the equity market than is typically the case. Just part of the fact that we just mentioned, a lot of the build-out has to be financed on the debt side, and so credit should underperform equities, we think.
Dirk, always great to have you on the show. Thank you.
Thanks for having me.
Coming up, we take a closer look at Bitcoin sell-off. That's next on Market Domination. Bitcoin continues to slide here, dropping from its record high of over 126,000 down to about 91,000. For more on what this means for the crypto market, let's welcome in now Swan Bitcoin CEO Corey Klippsten. Corey, it is great to see you. So Bitcoin here, we've seen a drop of more than 25% from that record high in October. Corey, let's start here. What do you think explains this move, Corey? And do you see it as, okay, this is a temporary slide, or no, buckle up, this could be the start of a long-term sell-off?
Well, you and your colleagues know me by now. I'm always going to take the approach of let's zoom out. Let's remember that this is a multi-decade install of a new monetary sort of basis for global commerce and economic cooperation. So this is not something that gets judged in the near term. Obviously, for those of you that are trading it, it makes a ton of sense to be paying attention to moves, and you've got to track the macros and NASDAQ correlations and all these different things. But if you just want to zoom out a little bit, we could just go back. I just checked the price 3 years ago today. So this was in November of 2022, and it was 16,000 something. So it's up 5.5x in the past 3 years. That's a CAGR of about 75, 76%, I think. And then if you go back, kind of when this, I guess the market started to look like it was today, if you go back to March of 2020, in the sort of COVID shutdown era, Bitcoin was trading around like 6-7K. It actually dipped down overnight below 4K on the COVID crash night. So let's just say it was something like 5K. I mean, it is up 19x, something like that. And that's probably a 65, 70% CAGR since March of 2020. So this is something that I think is currently ranging. And I think there's a nice base being formed with kind of building that muscle memory and that price memory of Bitcoin somewhere between 75 and 125K, which is where it's been ranging for a year and a half now. And I don't really get too stressed out about anything. I would start to get really worried if we actually saw a dip below 75K, and then I would say, okay, well, now probably people are backing up the truck first and buying a lot of cheap Bitcoin. But it seems perfectly within reason that it would range here for a little while, consolidate before shooting up more.
And when it shoots up more, Corey, what are the potential catalysts on your radar near to intermediate term?
Yeah, look, there's been a fun theory floated recently that 100K was something like Bitcoin's IPO, and it actually kind of rings true just anecdotally because it's I've been in the space and buying Bitcoin since 2017, so I'm not an OG, but I guess I'm turning into a bit of a long-time hodler, as they say, and it just, for some reason, that round number, that 100,000 was something that was always talked about. Everyone I ever talked to, would have conversations about, how much of their stack might they sell if it gets to 100K and things like that. So I think there just is some portfolio diversification going on with people that have had giant stacks of Bitcoin that they picked up in the single digits, double digits, triple digits, and they've seen these run-ups of, 1,000x to 10,000x in their Bitcoin purchasing power pile, I guess. And it makes sense that there would be some selling around this level and that it might be kind of extended. And then I think, you layer on all of the macro elements and the tariffs and uncertainties and everything else that's going on. And I think it's just, it still is trading as a risk on asset. It is a speculative store of value. It's something that a lot of people are betting on becoming a much larger store of value over time to rival and potentially surpass gold in the coming decades. But at this point, at 2 trillion market cap, it's still pretty small, and it trades 24/7, and it's usually kind of the riskiest thing in a lot of institutional portfolios. And we know now that over half of the value that's been stored in Bitcoin actually came in above 100K. So, it is relatively recent that these Bitcoins have traded hands. And so it's just not that surprising that you would see a bit of a sell-off if that's kind of the overall market trend as well.
So Bitcoin store of value, do you see, Corey, ever Bitcoin as, it's a true currency, it's a popular medium of exchange, or no, that's stablecoin's role?
So yeah, I think, look, stable coins still suffer the same problem that the dollar does. They are just digital dollars, and so their value erodes as we print more and more money. And if the plan is to export the debt of the United States by printing more and more money in the form of basically a new euro dollar system and just exporting stable coins and marketing them all over the place, it's still a melting ice cube. It's still going down by, probably 7% per year in purchasing power if you look at the real inflation numbers, and it pales in comparison to Bitcoin as a long-term store of value. So that story doesn't change despite the sort of relative superiority of triple ledger accounting with stablecoins on blockchains. That's kind of superior to Swift and some other things. But yeah, the long term, it doesn't matter. I think in the end, we will someday see the sunsetting of the dollar system. And I personally don't think it's going to happen this century, but I do think you'll see the continued rise of Bitcoin alongside the dollar. And, someday I do think that we humans, first of all, will be using Bitcoin much more often in the West as a medium of exchange, just because over time it will lessen in volatility and you'll just be more comfortable with that. Probably more adoption will lead to changes in its cap gains treatment, and you'll have different exceptions. Maybe at first we get, anything under $600, you don't pay cap gains tax, and then maybe they'll increase it to $10,000 or something like that. But that's just going to be based on people asking for it and that being a popular thing to do from a legislative perspective. So that just comes. I think you're obviously very dialed in on the 3 functions of money, and first comes store of value, and after it's a widely used store of value, it becomes a widely used medium of exchange, and then someday after it's a widely used medium of exchange, it becomes a widely used unit of account, and you actually price things in Bitcoin. But I think the thing that people need to realize is, have some patience. This is not the rise of an iPad. This is not the rise of Facebook. It's not a consumer product. This is a technological revolution, and those things take 5 to 8 decades to achieve full install. So have some patience. We're in year 16 or 17, and it's going to be a much longer story.
I'll get you out of here on this question, Corey. I want to get your take on whether you think Bitcoin could one day be as big as the gold market. I asked because Michael Saylor, recently speaking at the Yahoo Finance Invest Conference, and we asked Saylor that question. You might not be surprised to learn he says yes. In fact, he says it will in fact be bigger than gold, he says, within a decade. What do you think, Corey?
Ooh, I love the over-under on that. That would be tough. So you're talking 2035?
Yes, sir.
That's honestly, that probably sounds like a pretty good even money bet to me. Sorry, I went to a football game yesterday and everybody's talking about gambling all the time. But that seems like a good over-under. I wouldn't, bet the farm on that. It does, I think, because it is superior monetary technology, and I think it's just it's a matter of people waking up to that and more people realizing that and adopting it as a store of value. It really is. It's better in every way other than history, just the time that it's been used as a store of value, and obviously gold crushes in that. But I think Bitcoin catches up to that relatively quickly. We just keep on watching TikTok next block. Every 10 minutes it continues to work, and it's out of anybody's control, which is what you want with money. And I think it eventually, inevitably surpasses gold's market cap. It's just kind of a matter of when that happens.
Corey, great to see you. Thank you.
Thank you.
Now time for some of today's trending tickers: Apple, Home Depot, and quantum computing. Let's start off here with Apple, because shares of the tech giant, they're lower after Warren Buffett's Berkshire Hathaway disclosed that it sold off more of the stock. The firm shedding $10.6 billion worth of Apple shares in the third quarter. Berkshire has sold nearly 3/4 of its Apple stake since mid-2023, but it still remains the company's largest stock holding at $60.7 billion. Home Depot shares slightly lower as it's set to be the first retailer to report earnings this season. Its third quarter results are out before the open on Tuesday. The home improvement retailer has struggled this year as rising prices and a softening housing market weigh on the consumer demand. The stock is down over 7% so far this year. And shares of quantum computing jumping after making significant improvements in revenue and net income in its third quarter. Company reporting income of $2.4 million in the period. That's compared to a $5.7 million loss a year ago. Quantum Computing announcing its first purchase order with a, quote, top 5 U.S. bank, its first commercial sale of its quantum security solutions in the country. Well, Apple's rise into a multi-trillion-dollar powerhouse wouldn't have happened without CEO Tim Cook. He's led the company since 2011, overseeing everything from the iPhone X to the launch of Apple TV Plus and the Apple Card, expanding the company far beyond hardware. Now Apple faces new pressure from Wall Street, not over profits, but over its slower move into artificial intelligence and the search for its next big product after the iPhone. That's led some analysts and experts to ask whether it's time for a more product-focused CEO to now take the reins.
Cook continues to be the Hall of Fame CEO. He will lead Apple, I believe, at least the next 5 years.
It wasn't that long ago that you could give Tim Cook credit as having created more value as a CEO than any other CEO in history. And we're talking about like 2 to 3 years ago. It's not that long ago.
I think there's a sense that, maybe some fresh blood in terms of the thinking within executive management would make some sense.
The conversation about what comes next is already underway. Apple's longtime chief operating officer, Jeff Williams, was once seen as Cook's likely successor, but he has officially retired from the company. Among those who could eventually take over, software chief Craig Federighi, known for his high-profile WWDC appearances, hardware head John Ternus, who led Apple's shift to in-house chips, marketing veteran Greg Joswiak, who has been with the company since the late 80s, services lead Eddie Q, who oversees the company's fastest growing segment, and retail and people chief Deirdre O'Brien, a 30-year Apple veteran with deep ties to its culture and customers. Now, for now, Tim Cook remains firmly in control, but as Apple charts its next chapter in AI, streaming and services, the question of who will one day lead one of the world's most valuable companies is beginning to take shape. Well, the Financial Times is reporting that Apple is ramping up its succession plan efforts, preparing for CEO Tim Cook to step down sometime soon. So who is in line to replace Cook? Well, join me now on that very question. We got Yahoo Finance tech editor Dan Howley. Dan, as someone who has covered this company backwards and forwards for a long time, give me your pick, Dan. Who would be your pick to take the reins and why?
Yeah, I mean, I think Federighi is interesting because of his charisma. Obviously, he's always there at WWDC, but I think, he's on the software front. For Apple, I think right now that's, probably the main thing that everybody's focused on because of the AI aspect. But when it comes to products, I mean, it's going to come down to hardware. And so that's where I think the conversation with John Ternus comes in. He's the SVP of hardware engineering. He's overseen launches of the iPad, AirPods, iPhone, as well as you said, the kind of push to Apple's own silicon from Intel. So he seems to be the one who everybody's kind of lining up as the successor. He's also got age on his side. He's a little bit younger. And so that would give him a longer time to lead the company. And I think that's, going to be something that's important because Apple, traditionally does things in-house and they generally favor stability. This isn't a company that you usually see have huge transitions when it comes to management. And when there are changes in management, it's a very big deal. And so, it would really, in my mind, come down to those two, just on the side of them being the heads of hardware and software. And, as I said, at the end of the day, I think with Apple, it comes down to the hardware. And so that's where Ternus kind of gets that leg up.
And Dan, a broader question on Cook. I'm curious what you make of his tenure there. As someone who has reported and written a lot about it, I mean, how would you sort of frame it, Dan? You know, has he positioned this company well for future success?
Yeah, I mean, for all intents and purposes, he's been the perfect CEO for the company, right? He was the COO, so he understood supply chain. He managed that incredibly well, especially during COVID and through that chip crunch that we had. And look, he took the company to nearly a $4 trillion plus valuation of points. Any given day, it's the second largest company by market cap on the planet. And so you couldn't argue against him being a good CEO. I think the one knock against him is that a lot of the products seem to have that have succeeded had their genesis under Steve Jobs, and so he hasn't really had that individual singular product that's exploded. You look at the AirPods, the Apple Watch, they're an offshoot of the iPhone. You look at the Vision Pro, and that hasn't really done well as a consumer product. And so I think that's one of the only main knocks against him. Again, $4 trillion company. It's not like that when he's not CEO. I think the other thing is obviously the discussion on AI. I've argued for a while that this is kind of at this point overblown a bit, just because there's no singular feature with AI right now that I think people say, well, I got to go out and get it. I think for the most part, people are using ChatGPT, the app itself, or they're going to the website. I don't think most people are saying, well, why can't I do that on my iPhone yet? If they are, they're going to use the app. At some point, Apple will get there. Don't forget they were late to the smartphone. They were late to wireless earbuds. They were late to smartwatches and trackers, and they've just managed to dominate those markets. And so, yes, they're behind right now, but that doesn't necessarily mean they're going to be behind forever. And there's rumors that they're going to be working with Google, using the Gemini models. And so, I think that knock is a little bit overblown. I think it comes down to more of the products themselves. But I mean, overall, this company wouldn't be what it is if it wasn't for Tim Cook kind of leading the charge there.
Dan, thank you. Appreciate it. Coming up, we have much more market domination right on the other side of the break. Palantir shares have been under some pressure lately, down around 12% in the last week as investors grow wary of lofty valuations for AI names. Palantir CEO Alex Karp joined Yahoo Finance's Invest event last week to discuss the stock and the broader AI race.
Where I do have a bone to pick with like traditional financial people, including their minions, the analysts, some of them, not all, is, do you know how much money you've robbed of people with your views on Palantir? Like, it's like they have all these views. There's no downside risk for their view. At what point, it's like, it really should be next to every statement. I said don't buy Palantir at 6. I said don't buy Palantir at 12. And the welder, plumber, technician who didn't buy it or sold too soon, I owe them money. And by the way, let me tell you something about Palantir that is very positive. By my reckoning, Palantir is one of the very few, if not the only, where the average American bought and the average sophisticated American sat on the sidelines or sold.
What do you think explains that?
Yeah, because the average American was a lot smarter than they were and listened and was not bigoted, was not held down by a whole set of training beliefs that were wrong. Like, what does it mean to build enterprise? What does it mean to have FTEs? What does it mean to go to market? What does it mean to get paid? Does your enterprise have to be parasitic? Should it be a parasitic? Should the host essentially be paying for the privilege of making your company larger and getting no value except for a weird feeling that you get from the parasite that you're better than you are? It's like essentially replicating the whole woke mind virus in the enterprise. They were open. By the way, they were also not only, they were not bigoted against some obvious truths that we've been saying for 20 years. By the way, these views when they were not popular.
Like what, Alex?
Like America is a better way to organize and live than any other place in the world. That even though it's better, we shouldn't be exporting, or especially it's better, we shouldn't export. We don't need to export our values abroad. We need to be strong enough in America so that nobody screws with us. including my views on the border. Like, we should have an actual border. We should have an actual culture. We should have meritocracy. We should not tolerate discrimination. If discrimination means against white males or whatever that is, we should build the best products. The products are going to have to be much better than any other products in the world, or they're not going to get implemented. I mean, all these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the elite. You know who they didn't piss off? The same people we're also making AI work for. The truck drivers, the plumbers. I run into people all over America and, quite frankly, all over the world. People who have like normal means who are now rich because of Palantir. You know who's not rich because of Palantir? The people who read the analyst notes and the people who wrote them. And you know what? They're also still kind of angry because while they're cruising along in their broken down car, the person cruising next to them in their beautiful Tesla is an actual worker in this, providing actual value, who may have gotten rich on Palantir. By the way, I love that. Nothing makes me happier than looking in my mind's eye at the bank executive who's hanging out with their thing, who's living on the drip of some high interest loan, watching some person who's free, American, riding their car, who did not go to an elite school, but knew enough, because they didn't probably go to elite school, to buy Palantir shares. And now are going to make even more money using our platform.
Let me ask you this. I want to end here. There is a book coming. I want your view on this. It's a biography of you, The Philosopher in the Valley. When I read this book, is it going to be a fair, balanced portrait of Dr. Alex Karp?
Well, I mean, it'd only be fair and balanced if everything was good. Look, it's 70% accurate. It's very.
What's the 30 that's not?
He's got Trump derangement syndrome, obviously.
How does that come out?
Like anything that Palantir's done, it's basically 2 books. It's one book about my childhood, which is a complex background, and came from nothing, and highly dyslexic and amorphous. It's like the whole thing: amorphous background. A little bit too amorphous racially, a little too Jewish, a little too very dyslexic, political. That part's fascinating. It's a little hyperbolic, but it's like 85, 90% true. Mm-hmm. Then, of course, the Trump derangement syndrome. The fact that President Trump did these courageous things in Iran, and closed the border, and Palantir's played a role in these things. Obviously, not the role that the people did the work or the president, but that just sets off this mind virus. So Karp has to be evil. It's that part of the book obviously is but it's so obvious that you can kind of read through it. And yeah, there's some things, but I guess it's a good read. I think people read it will say, oh wow, that's really interesting. There's some things about Alex I didn't know, and you can assume all the things you don't like about me are on the inaccurate side, and all the things you do are accurate. But I think a lot of people are going to read it. I think people will enjoy reading it.
Since we're talking politics, there, final question. And we've been talking for a long time, the two of us, years. How have politics changed in Silicon Valley as you've watched it? What's the arc been like, and how has that, if at all, impacted the defense tech sector?
Well, I mean, I'll tell you, the thing I get in most trouble for in my intellectual circles is the following statement. Silicon Valley, like the rest of the world, will listen to you if those ideas make you money. Now, of course, you still have to have convincing ideas that are true, but if those ideas are not tailored to real world things that work, in the Valley, quite frankly, is dollars, they will not listen. The fact is, and again, whenever I tell this to my intellectual friends, they stop talking to me because they want to believe that pure ideas change the world. Pure ideas don't change the world. I'll tell you what changes the world. Pure ideas backed by the military, in this case, hopefully the US, doesn't mean you have to use the military. If you're strong enough, like this is where I'm like, Palantir is not a neocon project. Our project is to make America so strong we never fight. That's different than so almost strong enough so we always fight, right? So your ideas get listened to if you are dominant on the battlefield, and hopefully so dominant you don't have to use it, but if you do use it, people are like, yeah, I'm not screwing with those. Or if those ideas make someone a lot of money. You still have to have the ideas. And in part, the intellectuals get so angry, my intellectual friends, it's like because they just think they write a book, someone reads it, and it changes the world. Nuh-uh. And like that's not the way intellectual projects have ever worked. The ideas have to have a real world input. And so the fact that Palantir is at whatever we're at, this changes the Valley. Because not only was the patriotism right, but the patriotism will make you rich. And that's what that impact on the Valley is going to be very long lasting. And I'm very proud of that. But again, you can't just be proud of the idea. That was right from the beginning. It was been right since the history of our country that our way of organizing, especially our Constitution, is superior. It's certainly superior for Americans. Again, superior for us doesn't mean we export it to everyone in the world, but superior for us since conception. But to make people listen up in their seats, you need to be dominant on the military and dominant on the economy. And Palantir plays a really but-for role in both of those areas, and that's something that I'm proud of, because not just because of the impact, but because the way in which it reverberates both in Silicon Valley and outside. And by the way, it also stands for anyone can make it. One of the things that's in the biography is read where I came from. Read that. There's no reason you can't advance in this society, and that's an important lesson for everybody, especially outside the Valley.
Coming up, we have our latest edition of Goodbye or Goodbye, which dives into the fintech space. That's next on Market Domination. Welcome to Goodbye or Goodbye. Our goal here is to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Infinity VC, venture partner and capital VC, founder and managing partner, Cameron Ansari. Cameron, great to see you, my friend, as always.
All right, good to be here.
We're going to go through what you like and what you don't like so much. We're going to start on what you like, and this is SoFi. Now, this one, it's had a nice move already, Cameron. This one is up more than 70% year to date. Most analysts have a hold on this one. Not you, Cameron. You say this one's a buy. Let's go through some reasons why. First one, business diversification.
Yeah, look, this is a company that SoFi, I think, stands for social finance. I think when it first started, it was in the student loan refinancing and kind of in the Facebook era. And it's branched out now to a full service bank. They offer lending, they offer investing products, they offer a checking and savings account, mortgages. So now they have multiple business lines, and in fact, I think as of the last quarter, the business lines other than lending make up more than half the revenue, which is very impressive.
Second reason you say you like this one, benefit from lower rates.
That's right. Look, like all lending businesses, the lower rate environment as the Fed starts to move the rates down is going to help them, particularly with their mortgage and student loan refinancing business. Mm-hmm. So I think that's going to be a nice tailwind for them and going to continue the momentum for the business.
What if I said, Cameron, I said, I'm listening to the Fed, man, and some of these central bankers, they seem kind of nervous about that inflation. I don't know if you're going to get that cut in December.
I agree. Look, I think it's, I think people are expecting a cut, but we'll see if that happens. I think they already did cut it once, maybe twice. So we've had a little bit of a trickle down, but if anything, it's going to stabilize, right? It's probably not going to go up. Which I think is going to benefit to the business.
Third reason, you say this one is smart to commit capital to higher profits.
Oh, they're really doing very, very well on the profit line. They're about 25% EBITDA margin. They're growing 30-40% year on year for a business of this size. Mm-hmm. They're at about $3.5 to $4 billion of top line. To grow 30-40% annually is quite impressive. So I think the profits, the revenue growth, I think that's the story here.
All right, so you made a convincing case, Cameron, as you always do. Before I commit capital, though, let's walk some viewers through what are the downside risks I should have on my radar.
I mean, this is really it, right? The upside, it's already been up, I think, about 100% this year. Excluding today. Today's obviously been a little bit of a bloodbath across the whole market, but this stock has a lot of gains that have already happened, and it's trading at a premium in terms of multiple to things like PayPal and Square and others. So, the hesitation might be, look, has the upside already been built in? How much is left from here? But the business looks like it's quite, on a roll. Anthony noted that the team is fantastic, so I think this business can do well for a long time.
All right, so that's one you like.
Yeah.
Let's talk about one you don't like so much. You would avoid Pfizer. Now, this one's interesting, because this one's been shelled this year.
Yeah.
It is down.
I don't want to pile on.
About 70%. Sometimes analysts, guys in the street will say, okay, well.
Now it's time to buy.
Listen, how much worse could it get?
Yeah.
You say not so fast. Let's go through the reasons why. One, weak earnings report.
Well, this is sort of why we're here right now, right? Is because they came out with the earnings report that was sort of shocking. Sometimes you see an EPS miss of like a cent or 2 cents and the stock will get punished 10%. These, Pfizer missed by, I think, 25% on the EPS result. And took down guidance for the whole year from something like $10 per share down to like $8 per share. So that's pretty significant for a business of this size to say we're going to earn 20% less this year than we thought we were going to. So that, I think, led to the rest of the kind of cascade that happened where folks start to lose confidence that they can actually grow the business, do estimating correctly, and they've had a management change recently, which is something else we'll get to in a second.
All right, second reason you would say avoid this one, potential loss of client interest?
So this is, the weak earnings were really a testament to the fact that their products in the market are old and antiquated. Fiserv is a very, very large business, a massive company that's the underpinnings of a lot of the fintech world. However, it's not a household name that you and I necessarily interact with because it powers other things. For example, Clover, which is a point of sale system that they operate, they may have seen at convenience stores and what have you. It's losing market share to folks like Stripe and Shopify and Square and others. So their products are kind of been Frankenstein together from acquisitions and everything they've built, legacy systems, but the whole is not working well in terms of customers feeling like they're innovating. I think folks are moving off Fiserv products to other things.
All right, the third and final reason you'd say, you know what, not in my portfolio, mood that there may be other shoes to drop. What's going on there?
We're seeing some Senate investigation into the former CEO who then moved on from the company to go to the IRS and the Social Security Administration. He had some government deals that were in process, so the Senate's investigating whether there was some conflict of interest that were not disclosed. And so there's a question about, have we really learned everything that's happened here, or are there going to be other things that we're going to be finding out about in the coming weeks and months? And so for those reasons, I think it's one to kind of just step back from and avoid as an investment.
All right, we're going to end here, though. How could you be wrong about this one?
Well, I mean, the reverse case of SoFi, right? This is one that's already had a big move to the downside. It is a massive, massive company that's very much ingrained in a bunch of the financial services that we look at in our daily lives. So, there is a stickiness to this company. It's not going away. But I do feel like it's sort of had a really loss of confidence, both in terms of the market and investors and customers.
All right, leave it there. Buy SoFi, avoid Fiserv. Cameron, always great to see you, especially in person.
Thank you. Good to see you.
Thank you, sir. And thank you all for watching. Goodbye or goodbye. But don't go anywhere. We got you covered with all the action following the closing bell that's coming up next. Nailed it, man. That was perfect.